Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. It's March 11th, 2022. Welcome to episode 3 of the Market Radar Report. I'm Artie here with Gamma. And let's get started with performances. So year-to-date performance, S&P 500 down 11.56%, NASDAQ down 18.46%, Russell down 11.56%, Dow Jones down 9.17%. Everything is still bearish on our models. We are still in stagflation. We're in a very strong stagflation regime. Actually, I think the strongest stagflationary regime we've had since 2006. We have deflation creeping up very slowly still. 5 weeks ago, we were at 27.4% deflation odds. That's essentially what all of our models are what the market is pricing in. So market was pricing in roughly 27.4% deflationary odds 5 weeks ago. Now we're up to 32%. So it's been grinding higher. We have our reasons for believing why we're not going to be hitting a deflationary regime and we're going to be staying stagflation. We'll probably touch on that during this podcast.
I'll take it from there. We'll just hop to the calendar. We have PPI final demand on Tuesday. That's going to be a market moving event. Remember, if you're watching the video, the market moving events are the red highlighted events on the calendar. So PPI final demand, which is the producer price index, is at 8:30 a.m. on Tuesday. And then we have retail sales on Wednesday at 8:30 a.m., followed by the FOMC announcement at 2 p.m. All these times are Eastern Standard Time. On Thursday, we have the housing starts and permits at 8:30 a.m., jobless claims at 8:30 a.m., the Philadelphia Fed Manufacturing Index at 8:30 a.m., and industrial production at 9:15 a.m. Following on Friday, we have existing home sales at 10 a.m. So let's dive in here. We had CPI come out this week at 7.9% year over year. That's the highest since 1982. And consumer confidence came in on Friday at the worst level in over a decade. And this goes back to the issue we have right now with inflation. If you don't know, inflation is an extremely regressive tax, and it's something that affects the lowest income individuals because everyone needs to buy gas and food, right? So the higher gas goes, everyone has to pay that price. The higher a loaf of bread or pasta or whatever goes, everyone has to pay that price. And obviously, those people who have more money can afford these things at a better rate, and it's less of a negative to their financial situation. Now, this is all in the face of the upcoming Fed meeting, the FOMC meeting. We have this on Wednesday. And the big problem that we have right now, we had Janet Yellen come out today, and she basically said that she's going to look for a soft landing in the economy and we're not going to have a recession. The problem is we are already in a recession. There is no avoiding a recession. This whole talk of how is the Fed going to navigate? How are they going to cut? I should say, excuse me, how are they going to tighten in a fashion that's not going to create a recession? Well, the problem is we are already in a recession. And a recession to us is a risk-off environment, stagflation or deflation. Whenever growth is decelerating, we are in a recession. There's a difference between a recession and a depression, obviously, but we are in a recession. So the Fed is faced with hiking into a current recession, not a potential recession. They are going to hike into a current recession, which is just going to exacerbate what you're seeing in the market, but it's what is needed for the people. Because remember what I said earlier about inflation being a regressive tax, which is basically something that is it's what that means for the listeners that don't understand economics or new in the space. It's something that's disproportionately affecting this a society. It's not something that's equally weighted across society. It's disproportionately affecting those who in a way that it hurts them the most. And with what the Fed is doing here, we have the path of rate hikes. We're looking at roughly 6 rate hikes into the end of the year. And this is all in the tails of what the Fed is trying to do of curbing inflation. Now, inflation is not going anywhere anytime soon. They're not getting rid of it anytime soon. Like I just said, we're at 7.9% year over year. That doesn't just collapse, especially with what we have going on with oil shocks, oil and the supply shocks that even are lagging from COVID. It's just something that's going to be sticky. And this is the problem that the Fed is faced with because they will have to hike. And this is something that they normally would be cutting in this environment. This would be an environment where they have to cut, but they missed the environment to hike. So now they're behind the curve hiking into a slowing economy.
So let's let's cut back to inflation. How does a regular person, so someone who's not involved in the markets, regular
Right.
person working their 9 to 5, how does someone like that protect themselves against inflation?
That's a good point. So the problem with inflation, like I said, it's regressive. So usually those with the least amount of money feel it the most. So if you're looking for an investment objective for them, they really don't have the money to do that. If you're looking for the average person, I would say, um, in reality, you would look at things like commodities, materials, things that you've been seeing on a run lately. Those are all inflation protection because they have the pricing power. They have the excuse to raise prices from commodities. Now, how does someone protect against inflation? In the other sense of, are you talking about their the way that they live? Because they can't really do anything with their lifestyle, right? Because inflation is a self-fulfilling prophecy where if you know prices are going to go up, you're going to buy now rather than wait. For example, here in the northeast coast of the United States, we're just getting out of the coattails of winter, right? So the surge in home heating oil is luckily happening after the coldest part of the year. But still, like, even if you need heating oil, do you buy a lot of it right now, or do you just buy a little bit to get you by? Now, if you think heating oil is going to be lower next year, you'll buy a little. But if you think heating oil is going to be a lot higher next year, you're going to load your tank this year in anticipation of next year, right? Now, this comes down to also the education of the individual that's making this decision. Do they understand this cyclicality behind heating oil and or inflation in the waves that it comes? Or do they spend everything all at once because they think it's going to go extremely higher? Right. And that's where we are today. We have people claiming that cars are now hard assets because you can't get them. But at what point can you get them again? Right. And
Yeah,
this is the problem.
it really seems like we're in a situation where any physical asset is ballooning because no one knows where else to put their money to protect against inflation. So that's why you're seeing used cars sales. Used cars are booming. You can get a new car for cheaper than a used car. And
Yeah, that's crazy. Isn't that
yeah,
crazy?
and same goes with the watch market.
Oh, that's
Rolexes
insane.
going
Yep.
for insane prices, everything way over sticker price.
Yeah.
That's what we're seeing. It the regular consumer, is in a pretty shitty position because all of these hard assets are already pricing in inflation. So if you don't already have the money, it's pretty hard to get these hard assets that do, in fact, protect you against inflation. Because at the end of the day, hard assets do protect you against inflation. That's why people buy homes. Homes are a good inflation hedge. Any commodity, that's why people buy gold. Same with copper, any metal. Um,
And
but
that's a good point where you say hard asset. I don't mean to interrupt you, but a hard asset is something like land, like you said, housing, commodities that you can raw materials that you can convert into something to basically sell. That's a hard asset because you know you buy a bushel of corn, someone's going to need the corn.
yeah,
Right, or like let's just say you buy um barrels of water. People are going to need the water. Water's a hard asset.
yeah.
What
It's actually
oh
funny. Like Michael Burry, doesn't Michael Burry just invest in water
yeah,
since
that's like an old
2008?
thing. Yeah, yeah, that's great. Yeah, it's funny he comes up in this conversation, but yeah, he was a big water investor, and it makes sense because water's something that everyone needs, right? And same with like I said with corn or any of these raw materials that are required to produce or consume, people need them. Now, in the past couple of years, people have moved this terminology of hard asset into another category where they'll say a Rolex, an Audemars, a Patek. These things are hard assets, but they're not. They're really not if you think about it. They're just produced in such low quantities and the rate at which individuals have money has increased. Okay. Or I should say, you saw one of the biggest stock market booms in pretty much ever the last 18 months before the decline here. People were making money hand over fist in the stock market. It was easy for them. Think about it. Think about all the people we were talking about in the other podcasts, the Zach Morris individuals, the Atlas trading groups, and these small penny stock pump rooms. They were running every day. Now, those are all individuals that didn't have money before COVID and have amassed a lot of money after COVID. So just sampling that market, the amount of people that came out of there that could have afforded these types of things increased dramatically, yet supplies got constrained due to COVID. And they already produced in not so absorbent amounts. So the demand alone plus the supply constraints put these things trading 100% over sticker. And this is the effect of inflation because if you just had one of the biggest inflationary booms, and that's what but that's what you saw in all of these items that people call hard assets. I mean, somebody tried to make a claim to me that a Lamborghini is a hard asset. Think about that. A Lamborghini, a hard asset.
Yeah,
They said because they don't produce them that much that it'll go up in value because someone will be willing to pay it. And this is the prophecy, or I should say the self-fulfilling prophecy of inflation. If I buy a Lamborghini, or I should say, let's just say I buy an Aventador for 500,000 and I'm going to sell it because I know someone's going to pay 600, 800 grand. Well, the guy who's buying it from me from 6 or 800 grand either really likes the car or he thinks he's going to have someone that he could sell it to for 7 to 800 grand. Same thing with a watch. Someone that buys a watch 50% over sticker thinks that watch is going to go up even more because if they thought that watch is going to drop to sticker, they would never buy the watch unless they just don't care.
yeah. And that's what when the Fed talks about inflation being sticky, that's what they mean, right?
Right, exactly. And there's an issue with these quote unquote hard assets that people are moving, or I should say that are maneuvering their financials around, is there's the old rug pull. Okay. It happens all at once where there's a lot of individuals that own things that they have no business owning, but they own them because they see them constantly going higher. Again, I'll go back to the self-fulfilling prophecy, you know? The only reason someone's buying something over sticker or that much over sticker is because, again, they either like it or they think they could sell it even higher.
Yeah. And when that's the only reason you're buying something is because you think you're going to sell it higher, that's that's when you get into dangerous territory. That's
Right.
that's
Right.
the that's where cryptocurrencies, Bitcoin, that's where they were before every major crash.
Yeah,
Yeah.
and you know what? We'll segue right into the market here. So let's talk quickly about what the S&P 500 is doing. Now, for those that are listening, the S&P 500 peaked at pretty much the beginning of the year, made an all-time high on the S&P 500 futures contracts. From that all-time high, we are currently trading down 12.81%. Now, we are back to prices last seen in June of 2021. But we haven't seen a flush yet. And what or I should say we haven't seen a puke yet. And what do I mean by a puke? What I mean is we haven't seen an aggressive an aggressive liquidation. We haven't seen something that just screamed annihilation. And there's a few reasons why we haven't seen that. And I'm going to go into some detail here with what the Fed is proposing and what people are believing. So, the Fed is telling you that they're going to hike. I think we said, what was it, 6 or 7 times, right?
Yep.
Right already? Yep. So the Fed's going to hike 6 or 7 times. A lot of people don't think the Fed is going to hike 6 or 7 times. They don't think they're going to get off with more than 3 rate hikes. They think the Fed's going to hike once and basically pussy out. But
And
long
that
story short,
that
go
would
ahead.
mean they're going to let inflation rage, right?
Yeah, yeah, and they're not going to do that. We went into that in the prior podcast of their two mandates, one being employment, and the other one being price stability, right?
Yeah.
So we know the Fed is going to try and curb inflation, and also they're in the spotlight right now. I mean, everyone's coming for Sleepy Joe, right? They're shooting him down for this inflation thing. It's really not all of his fault. I mean, sure, he's done some things that have made it worse, but this is a problem that's been being that has been kicked down the road for decades at this point. Since QE in the great financial crisis, this has been a, a revolving issue for the Federal Reserve. The Federal Reserve has not been able to get rates higher on a hiking to cutting basis from a trough to peak. Basically, every time that they cut and they hike, they always are hiking to lower levels. And I think I can bring this up for yes, I can. So since we collapsed in 2007 and 2000 prior to the collapse of the market, or I should say interest rates in 2007, we were at a 5.25 federal funds rate. We collapsed down to zero. We were able to get back up from 2015 to 2019 to 2.35 and collapse down to zero. So the big problem here is, how do you squeeze out inflation at 7% if you can't get above 2%? Because remember back in the 1970s and 80s when we had this stagflation issue where Volcker let rates rip to 15%, to squeeze out inflation, which was at 15 to 18% at the time, right? Or you let rates run to 19%, sorry, and inflation was roughly the same to squeeze it out. Well, inflation's at 7.9%. We can't let rates run that, but it wouldn't work. That's really what it is. The Federal Reserve cannot hike rates, especially this quickly. You know,
And so
you're
the
talking
market
about to
knows
get
that, right?
yeah, of course the market knows that. And I mean, the market. This is what makes us unique in the situation is that we don't run into this with a story. We don't run into this with like some type of news bit we're trying to sell people or whatnot. We read what the market's pricing. So our regime models are just pricing in, and our market analytical models are pricing what the market is telling us now. So let's go back to the FOMC page, or I should call it the Fed Watch tool for those listening. The Fed Watch tool has us in at 1, 2, 3, 4, 5, 6, 7 rate hikes by year's end, pretty much. 7 rate hikes. So I think we said 5 or 6 earlier, but it's 7 exactly. Now, if the Fed Watch tool has 7 rate hikes priced in, the Fed Watch tool is designed by reading the outputs of futures contracts. So this is not just a guess. This is live futures pricing. So if the futures are pricing this in, or should I say the Fed fund futures are pricing this in, ES already knows about it. S&P, SPY, QQQ, your whole night, they already know about this. This is already priced in. If this is priced into the Fed futures, it's priced into the S&P futures, meaning SPY is already pricing this in. So it would actually be a bad thing if the Fed comes out and backs away, because then they know that inflation is going to run even more rampant. And there becomes a real problem. Gas at where it is by me, it's roughly $4.50 a gallon right now. Gas at $8 a gallon or whatnot, if they let inflation run, it doesn't really matter what the S&P 500 is going to do. People start liquidating or start pulling money out because they have to spend money to live. There becomes a cost of necessity. You understand you know what I mean?
Yeah.
Like you got to buy gas. You got to buy heating. Well, we're out of the winter now, so the heating oil is not nothing. You got to pay for electricity. You got to buy food. You got to buy gas. You got to buy clothes and all these necessities to live. These are things that, some people will say, I don't need my money in the market right now. I can always make more money later. And you run into that issue. So regardless, the Federal Reserve if the Federal Reserve deviates from the path that the market is pricing in, I can't see it being good either way. Like I can't see them saying, oh, we're going to hike faster, the market's going to go up, or we're going to cut faster. We're going to hike at a slower rate, I should say, and the market's going to go higher. This is doesn't make sense.
Yeah.
Everyone on the internet, on Twitter or whatnot, that's saying, "Oh, the Fed's going to go do 2 rate hikes." That's what that's what this market is telling, or I should say, the Fed's going to fail at their 7 rate hike procedure, and the market's going to rip on that. Well, we know the markets are designed to beat inflation, but when inflation is eating growth, which is what stagflation is, right? So growth is slowing, but companies are growing even slower because now their costs for goods go up even more. It's a cycle, right? So like their profit margins slow and their growth rates slow even more because as the longer stagflation is around, because they have to pay for more materials I should say that they pay for materials at a higher price for longer. So you want them to squeeze out inflation. But, or I should say stagflation, right? You want them to squeeze out stagflation and get us back to either deflation or positive growth regime because that's where we want to be. Deflation, the market can handle. Stagflation, it's tricky. But the problem we have right now is that we have to see what is going to happen with the rate of inflation. The Fed, at the end of the year, the Fed completes its 7 rate hikes. Who knows? Maybe the Fed, by the way, comes in and does some crazy stuff where they don't push they decide to go slower or whatnot. We'll see. But if the Fed meets what's being priced in of 7 rate hikes, we'll see what happens to inflation. That means that the Fed funds rate should be, between 2% and 2.25%. Now, what you're seeing in the market right now, if you're watching the S&P 500, we'll just take SPY for those to make it easier for those who are listening who don't understand futures. So SPY closed at 420.07. Where is the dump? What we mentioned earlier, the puke. It hasn't come, right? If you go back at any time in history, you'll understand what I'm talking about with the puke. It's aggressive. It's not 1-2 days. It's 3-4 days of selling. Everyone does. People question this. It's when people question the stock market. Is this for me? That's the puke. We haven't seen the puke yet. The
And
puke.
when people start praying, that's the puke.
Yeah, exactly. A puke would be SPY from 420 to, you know, 390 by the end of next week. That's a puke. Now, that's something that, you start doing that, people get they get disconnected very quickly. And there's a lot of reasons why we haven't seen the puke, why you're seeing the market hold up the way it is. Number one, FOMC meeting on Wednesday. People want to see what's going to happen. I mean, we already know that Powell basically soft confirmed this. He soft confirmed a 25 basis point hike on Wednesday, a week or two ago. But the market's really looking for what the Fed is going to say moving forward. Confirm what the Fed fund futures are pricing in. That's really what the market is trying to figure out here. Number two, why you haven't seen the puke is we haven't seen a large amount of selling in high beta names. There's been some high beta resilience. And what is high beta? High beta are the big names that make up the market: Apple, Nvidia, Tesla, basically things that move with or at a rate of or above the rate the market's moving. So a beta of 1 means it will move in tandem with the market. So the market's up a percent, it'll be roughly up a percent, right? But a beta of 1.5 would mean if the market's up a percent, it'll be up 1.5%. So high beta is generally anything over a 1.0 beta. Now, let's bring up names like Apple. Apple has not seen any selling, and we'll only do a few of these. There's many high beta names, but Apple is still bullish trend on our DDAP model. We haven't broken down yet. On the other hand, something like Nvidia, we are bearish trend, but it has not broken down either. Sorry. Nvidia has not broken down either. It's at 221. Nvidia started the year off in 2021, not 2020, 2021. So a year ago today, Nvidia was at roughly $141. It's at 221 right now. So there's a long way to go from being back to last year's prices. Tesla as well. Tesla is still above the June prices at 795. At June, you were looking at 650. So you have not seen an aggressive breakdown on high beta names, which would really be the sign of a puke. The third thing and the final thing is volatility in VIX. So for those that are new, what is VIX? VIX is the volatility index, and it measures the implied move of the S&P 500 by option premium. So the VIX is at 30.74 at the end of trading on Friday, and that equates to roughly like a 2% a day move on the S&P 500. That's what 30 VIX means. You're roughly in a 2% up or down range. Generally, the higher the VIX goes, though, it's not 2% to the upside. It's the rare occurrence you get a 2% bounce. It's more of 2% downside. So VIX is something that's supposed to be a neutral weighting of potential moves, meaning plus or minus 2%, but it's usually the other way around. The higher VIX goes, the more downside risk there is. Now, you understand VIX. You have to understand that VIX also has futures contracts. Long story short, when you discuss futures contracts, there's backwardation and there's contango. So, what does that mean? Backwardation. Backwardation means the futures contracts which have expirations, okay? Futures contracts are kind of like options, but they expire less frequently, and they're, I think, as tightest on a monthly basis, and longest they're on a quarterly basis. So the futures contracts are 1 month or next contract, or should say current contract, and there's one contract out, and there's two contracts out, and you just follow the cycle until there's no more expirations left. So what backwardation means is the current contract. For example, hypothetically, let's say VIX, we're in March, so the next VIX contract, let's say, is April, and then there's one every month. So April, May, June. So the current contract, let's say, is April. The March contract, let's just hypothetically say, expired. We're now trading April. So There's also a second contract, right? Because it keeps going out. So there's April, and there's May, then there's June. So the second contract being May. Backwardation means the price of the April contract is going to be more expensive than the price of the May contract. Now, how does that make any sense? Well, that's the point. It's backwardation, right? So think of it like oil, for example. If I told you that next month I was going to buy oil at $10 a barrel, but then the following month I was going to buy it at $5 a barrel, you would tell me, okay, that means that you think between the next month and the month after, oil is going to come down in price. And that's what backwardation is. You're expecting short-term price rises with long-term decreases in value or decreases in price. Contango is the complete opposite. Contango is simple. Contango means prices are steadily rising as time goes on. What we're seeing right now in the VIX futures is what we call backwardation. And this doesn't happen often. It's where the current expiration of the futures contract is trading at a higher price than the following months or following expirations futures contract. So we are currently, as of Friday, at negative spot 22, 0.22, sorry. Meaning it costs more the futures contracts cost more now than they will in the next month. And that means that there's fear in the market. But this is the caveat here. Throughout this whole drawdown, we saw this VIX futures spread only widen to about negative 2.7, 2.7. That is not wide. Go back in time in any type of sell-off in 2018 when the market fell off into the end of the year. We saw VIX futures draw, or I should say, the backwardation of of the futures contract. So let's go back even more here. Yeah. So we saw the backwardation go all the way down to negative 9.7, negative 9.48. And then in 2018 into the end of the year with the whole Powell hike. I'm sorry if I said 2018, that this was the 2018 Trump impeachment, the whole impeachment thing where Trump was going to get impeached. The market fell, right? The whole nine that they were doing with that came down to negative 9.42. Then we had the 2018 crash where we came down to negative 4 spot, roughly negative 3.97. So it's about negative 4. That's where we came down to. Then COVID was the complete, blowout. We went all the way down to negative 15. The lowest we've seen is negative 2.67 in the last draw in this SPY or ES drawdown. We haven't seen a blowout yet. We haven't seen something that has said, wow, like people are really scared. And this is what we're talking about, the puke. You haven't seen an environment where people have been forced to liquidate. And that is coming. We believe that is still to come.
Well, so why do you think it's taking so long?
Why do I think it's taking so long? That's a good point. And I think that the reason it's taking so long is because of the situation we have right now with fund managers and whatnot.
Is it because no one knows what's going to happen?
Not so much that. I think it's that people have been conditioned to buy the dip. Now, if you're listening, you don't see the chart that I have up, but over the last 18 months, every dip has been confidently bought. We were also one of the craziest risk on regime sets that you probably will ever see. The rate that, I mean, you had tailwinds of the Fed, you had everything in your favor, right? Easy money, whatnot, market ripped. Now you're in an environment here where people don't know what to do. They're not sure if the market, there's a lot of people that think the market's going to rebound. They think that this is just one straight move down, bottoming out. We're going to go. People still have $5,000 price targets for the S&P 500 by the end of the year, if you could believe that.
Yeah,
That's
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 nonsense.
almost yeah, that's 800 points higher from here.
See, in a normal, well, not normal, but in the inflationary environment, yeah, that makes sense.
Right,
That's something you can expect. But
right.
those people putting those price targets clearly don't understand that the regime has shifted.
They don't. And I think another thing that's preventing the market from drawing down is you haven't seen people spend their cash yet. What I mean by that is, so this is how this works. For those that don't understand, when someone's averaging down or they're quote unquote buying the dip, which we all love to buy the dip, by the way, it's just a matter of when you're buying the dip. Are you buying the dip in risk on regimes where you think that the market is going to go higher because you have tailwinds, or are you buying the dip in risk on regimes where you have headwinds and things are not in your favor, right? If you're buying the dip in risk on regimes, it's actually relatively easy to. I don't want to say this, but it's a fool's game. Like you can anyone can really do it. You know, just buy on red and just wait, right? Everything's go up. You don't have to do much. You just sit back and say, okay, I bought the dip and now I'm going to wait. It's the risk off regimes that kill the buy the dippers. It's the risk off regimes where they buy and the dip keeps on dipping. And what happens is they run out of cash. Let's just say you have 100K in your account and you spend or you're allocated in a position 20K and you liquidate everything else because you want to average in there. Or let's just say you only have 20% total and you have 80% cash, right? And you start allocating 20K on each dip. Well, if you have 20K, you only need 4 dips for you to be out of cash. So 4 dips come by, you're out of cash, right? Now what? Well, there's this beautiful thing called margin, right? And if you're like, okay, I can leverage the position 2 to 1 because psychologically it makes sense, right? The stock's down. So if I borrow money when the stock's down, when the stock's up, I'll have even more money. Problem is you keep buying the dip and you just borrow, and then you hit your 50% or whatever your broker's letting you borrow, and you're tapped. And then it keeps on dipping. And then you get what you call a margin call. And this is the puke. This is where the guy who had 100K now has 30K on something that maybe only moved down 30%,
Yeah,
but he's
and
down 70, right?
that would make sense too because the way the market's been trading, it's really sucking people in from both sides.
Right. And that's typical stagflation, right? Like the market's
Yeah.
going to absorb the bulls, burn them, and then in the process capture the shorts to burn them. And it's just a seesaw, just bang, 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 burn, 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 burn. And that's what you're seeing, right? Every day. I mean, we'll go down to an intraday. For those watching, you can see this, but for those listening, we in the last intraday session from Thursday's low to Friday's peak was 2.85%. That is not normal for the S&P 500 to move that in 24 hours. Actually, less than that. If you're looking at the times, it goes from 11:30 in the morning till 6:15 the next morning. Not even 24 hours. We moved 2.85%. This is not an earnings call. This is the S&P 500. But this is the outcome of VIX 30. Actually 30.74, but you get my point. This
Yeah.
is normal in this environment. Burn bulls, burn shorts.
And
That's what's
so
going on.
let's get into what the play is here. So
Right.
nothing has really changed since since we started doing these podcasts basically. We've been in stagflation for quite a while now. So what is the play for those just tuning in now? How do you survive this?
Well, that we're positioned in our accounts for a risk off regime or risk off environment. I don't like to use the word regime because we only have 4 regimes. 2 of them are risk on, 2 of them are risk off. But long story short, We're positioned in a way that no matter the outcome, as long as SP or ES and S&P 500, whatever you want to call it, we'll just call it S&P 500 for those listening. As long as the S&P 500 stays in a bearish trend, we should our portfolio should bode very well. It's if things turn around rapidly and we go risk on, we'll probably see some pain and we'll have to rotate our portfolio. But we're basically long safety, short risk. Shorting risk is where we're holding most of our positions at, and long safety is the hedge. But we have almost 45% cash last time I checked. So it's not like we're aggressive in any manner. Um, we're set up that we think the market comes down more. We think the market goes lower. We think that the S&P 500 goes to 4,000, maybe even lower. But 4,100 is our first target, and then 4,000 is our second target. But targets are meaningless, right? Like what we just throw those out there to entice people. We really think the S&P 500 continues to go lower. How low? Who really knows? But it's a matter of that it will continue in a bearish trend. That's what matters. As long as you know where it is going, you can prepare your portfolio for it. So S&P 500 is going down. Now the first action one would take is say, okay, market's falling, I'm going to buy bonds, right? And I think I'll take this into the next step, Artie, with what you shouldn't be doing. You shouldn't be buying bonds right now. Or at least we aren't buying bonds. We're not financial advisors. I can't tell you what to do, but TLT, for example, is at 134 spot 91. TLT is down 8.98 spot 96% year to date. 8 almost 9% year to date. The S&P 500 is down 11 spot 56. 11 spot 56. Bonds are down 9%. There's no hedge there. So, what do? Well, you don't long gold either. That's something you shouldn't do. Because remember, gold is tied to real yields. We think nominal, meaning treasury yields, the 10-year, 30-year, whatnot, they're going to go up. In turn, we think real yields are going to go up too. And there's a strong correlation to real yields and and gold. So they're very inverse correlated. So meaning real yields rise, gold gets crushed. You don't want to be long gold and have real yields rip in your face and get crushed, and that's your hedge, and the market's getting crushed because you did nothing but just move risk into another correlated asset. So you might as well just hold what you're long already and not have to realize the taxable event to do it. But your biggest thing, what you can do, is going to be having cash. You want to be ready to buy the dip when risk flips back on. When risk flips back on, wherever we are, usually out of these deflationary or risk off periods comes a rally, comes a nice rally. You know, we saw this in 2018. Actually, no, that was risk off. We saw this in here out of the 2016. We had some risk off areas, and out of that, we had a strong rally. Now, granted, this was Trump's tax cuts or whatnot, but long story short, the environment is what the environment was reading what the market was telling us. And generally, risk on environments are very rewarding for those that are long. Okay? Being long in risk off environments does nothing but draw your portfolio down, and it takes longer for you to break even. And that's the big problem, you know? Let's just say this is the big problem with the buying the dip, and we'll touch on this one more time, is when you buy the dip and it keeps on dipping, when do you stop buying? Like, what's the point? You just when do you average in 20% higher from where the price will be? This goes to us saying that SPY is bearish trend. S&P 500 is bearish trend. It can continue to be bearish trend for 100 points from here. Would that be brutal at 320? Very brutal. But do you see what I'm saying? There's no you don't know when to buy the dip. The whole point of a bullish trend in a risk on regime is You have high confidence or high conviction in the dip. There's no conviction in this dip. We don't know when this is going to end. And that's the big thing behind what we're looking at is when are we going to get out of this? And we want to have cash for when we do. That's why we have cash, that we were 40% cash for that reason. And I think we're going to tie off this podcast with understanding real yields because I think that's important. So we spoke about this in another podcast, but real yields are basically the difference between the current US 10-year treasury yield. There's multiple facets of real yields. We're using the 10-year US treasury. So for the 10-year US treasury real yield, it is the difference between the nominal rate of the current yield and the calculated break-even rate over that duration. So for 10-year, the 10-year yearly break-even rate on inflation. That's what the real yield is, and we have that right here. We're going to pull it up. Currently, the real yield is negative 0.94, meaning you're basically losing 94 basis points a year on a 10-year treasury. Yeah, that's right. You're losing on the treasury. So for those listening, when you buy a treasury, you understand that the treasury is guaranteed on principal, right? You put $1,000 into US treasury, you're going to get $1,000 back. Now it's a soft guarantee, right? Like nothing's guaranteed, but the US is going to just print money. Come on, let's be real. They're never going to default on their treasuries. At least not anytime soon. They're going to just print their way. They'll keep this up, right? So when you're buying a treasury, you're basically betting that the US is not going to default on their loans, which they're not. Now, what you're getting rewarded for is you're almost losing 1% a year. Now, you might think, oh, well, the US 10-year treasury says the yield's about 2% right now. Well, yeah, that's before inflation. You calculate the inflation or the cost of inflation every year, the break even, right? You take the current minus the break even, you get the real yield. The real yield means you're losing 94 basis points. What and remember for those listening again that are new, a basis point is basically 10 basis points is a tenth of a percent. So 94 basis points is 0.94 of a percent. That's what that is. Now, our opinion is real yields will go up. The Fed's going to be hiking rates. They're going to be squeezing the difference between nominal yields, and they're going to be pushing nominal yields higher and basically putting some, even though it's not a lot right now, by the end of the year, maybe it's a little bit, right? They're putting pressure on the break-even rate and they're adding support to the nominal yield rate, which is the current yield of the treasury, right? Right now, the treasury is yielding 2% with a federal funds rate of 0. By hiking the rate, they're just adding more support to that yield, and they're also pushing against the inflation or the rate of the break-even rate of inflation every year. They're pushing that down while supporting the nominal yield, meaning they're compressing the difference, meaning it should go back to 0 or close to 0. That's what we're thinking. There's some support behind this. If we look at in here, I have it on for those watching. Blue is real yields and orange is TLT. And I'll go over this for those listening. So these are also, like gold, very negatively correlated. What that means is when real yields drop, TLT goes up, gold goes up. TLT and gold move together. So by looking at TLT, you pretty much can see what gold is doing, roughly. What you're seeing here is a major disconnect. Let's look at in 2018 when real yields peaked, bonds started ripping, meaning real yields going lower. Real yields went from about 1.1 was it 1.15 all the way down to 0 and then negative, which is where we are today. TLT went from 112, 113 all the way up to 171. You're seeing real yields basically take a dip over the last couple of weeks, or I should say, last week and a half here, after peaking at uh, negative 42 basis points. Now we're at negative 94 basis points. Yet bond yields aren't ripping. Remember, these are correlated inversely correlated. So this drop in real yields should have pushed TLT a lot higher. Why is TLT not getting the bid? And this is the answer for this podcast. Why is TLT not getting the bid? Because the bond bulls, the real bond buyers know that this is not the time to buy the bonds, at least not yet. If it was, TLT would be, north of 145 right now, moving with this drop in real yields.
And that
Except,
that would be deflationary, right?
right, that's the point. So this goes back to us saying that we're going to stay stagflation for a lot longer. We don't see deflation actually materializing. And the reason we don't see deflation actually materializing is because for deflation to happen, you need rates to go down. But if rates are going to go down, remember, bonds are inversely correlated. Rates down, bonds up. Rates are going up, bonds are going down. So that's obviously not, it's obviously going the complete opposite of what's supposed to be happening in deflation. But if bonds were going to go up from here, real yields would have to go down a lot more, right? Real yields are already at negative 94 basis points. That means they would have to break down and move further lower for bonds to move higher. The problem is you have real yields going down right now, but bonds are still going down because there is no this is from what I can see based off of the correlation between the two. The way bonds are trading, it's very ugly. It's just liquidate, liquidate. They don't want to hold bonds. They want to dump fixed income because they know Fed hikes are coming. The Fed tightening, very bad for bonds, very bad for gold. And this is why we're positioned for being long real yields. We think real yields go higher. And TLT, as of now, is confirming that. Unless we see a major breakout next week with TLT north of 145 and screaming, then yeah, maybe there's a bid. But this goes also back to why is there going to be a bid for treasuries at a negative rate of return? They're losing 94 basis points. And this also goes back to what do you do? Well, it's very hard in stagflation because gold's an underperformer. Um, treasuries are an underperformer. But you know what isn't? Commodities. Hence, there's a lot of people that say oil could go higher. Well, yeah, if the Fed doesn't do anything about inflation, oil could definitely go higher. Because that's where money's going to go. Money's going to go into energy. Money's going to go into commodities because it knows that that's their hedge. But I think I'm going to leave it off with this for the week. If you're interested, we have a lot of these threads posted on our Twitter at the Market Radar. A lot of these are explained in depth. We're open for questions either on Twitter or in our Discord. Happy to answer any questions or ideas or what you're thinking or more on what we're thinking. The link to our Discord can be found at www.market-radar.com. And thank you so much for listening.
Yeah, well, that was good. Lots of detail in there. I'm sure anyone listening is going to have plenty of questions. So, yeah, as you said, we've got a Discord. Everyone's welcome. It's free. We're going to be in there answering any questions that you may have. Thanks for listening.